New Jersey just announced 6 of their 7 state pension funds will be completely depleted by 2027. Teachers' Retirement Fund goes bankrupt in 13 years. CalPERS lost $15 billion in 2 days during Trump's tariff announcement. And I just discovered that America's $38 trillion in retirement savings isn't enough to prevent 83% of workers from facing poverty in old age. I've spent the last 7 months analyzing pension fund mathematics and demographic projections, and what I found should terrify every person planning to retire in the next 20 years. This isn't about market volatility or economic cycles. This is about the systematic collapse of America's retirement security system, and when it fully implodes, it's going to destroy the financial futures of 100 million working Americans. Let me start with what happened last month that barely made local news coverage. New Jersey. Pension actuaries released updated projections using new calculation formulas that revealed the true scope of the crisis. 6 of the state S7 pension funds will be completely insolvent by 2027. A teacher's pension and annuity fund, serving 180,000 active teachers and 160,000 retirees, depletes all reserves within 13 years. But here's what caught my attention in the actuarial footnotes. Page 94 mentions that these projections assume 7% annual investment returns indefinitely. Current 10-year Treasury bonds yield 4.2%. Municipal bonds average 5.1%. The pension system requires impossible investment performance to avoid bankruptcy. Then, I found the leaked CalPERS internal memo dated December 3, 2024, Investment Committee document titled, Systematic Risk Assessment, Trump Administration Policy Impact. The analysis detailed how tariff announcements triggered $15 billion in losses over 48 hours, while pension obligations increased daily regardless of market performance. The mathematics are brutal. Pension funds promise specific payments to retirees while depending on market returns that no one can guarantee. When demographics meet market reality, pensioners lose everything. But here's what really keeps me awake at night. I've discovered a pattern that's destroyed every pension system in history when worker-to-retire ratios collapse. 4 stages, always. And right now, American pensions are entering stage 4. Let me prove this pattern exists using the most devastating example from recent history. Detroit, 2003 to 2013. Once the 5th largest city in America with 1.8 million residents. Industrial powerhouse generating massive tax revenues supporting generous pension promises to police, firefighters, teachers, and municipal workers. Stage 1 was promised expansion during prosperity. 1971,990. Detroit's economy thrived on automobile manufacturing. City leaders enhanced pension benefits during good times, assuming prosperity would continue indefinitely. Workers earned pension credits worth 80 to 90% of final salaries. Stage 2 was demographic decline meeting fixed obligations. 1,992,005. Detroit's population dropped 60% as manufacturing jobs disappeared. Tax base collapsed, but pension obligations remained fixed. Fewer workers supported more retirees while benefit payments increased annually. Stage 3 was financial engineering and denial. 2005 to 2010. Detroit issued pension obligation bonds, borrowed money to make pension payments, deferred contributions, and assumed impossible 8% investment returns. Political leaders delayed recognition of mathematical impossibility. Stage 4 was systematic collapse and betrayal. 2010-2013. Detroit declared bankruptcy. Pension benefits slashed 4.5% for current retirees, 6.7% for future retirees. Healthcare benefits eliminated. Promises made over 40-year careers vanished through legal proceedings. The pattern was predictable. The outcome was devastating. When fixed pension obligations meet declining revenue sources, mathematics always wins while workers always lose. Now let's apply this exact framework to current American pension systems. Stage 1 complete. 1950 to 1990. Post-war economic expansion supported generous pension promises across public and private sectors. Strong demographics with 5 to 6 workers per retiree. Pension systems appeared financially sustainable indefinitely. Stage 2 accelerating. 1,992,010. Baby boomers approached retirement while birth rates declined. Worker-to-retire ratios dropped to 3 to -1. Pension obligations grew faster than worker contributions. Investment return assumptions remained optimistically high. Stage 3 happening now. 2010 to 2024. States increased pension contributions to record levels while underfunding continues growing. New Jersey pays 31.3% of payroll toward pensions, double the 2007 rate, yet 6 funds still face insolvency by 2027. But here's what makes this crisis more dangerous than Detroit's bankruptcy: scale and interconnectedness. Detroit affected 700,000 pensioners in one city. Current pension crisis encompasses 22 million state and local government workers plus 62 million Social Security beneficiaries. Total exposure exceeds $44 trillion in unfunded promises. The demographic mathematics are inexorable. In 1950, 16 workers supported each Social Security beneficiary. Today, 2.8 workers support each retiree. I found something else while researching this story that reveals how rapidly the crisis is accelerating beyond anyone's projections. Pension debt paralysis has become the new normal across America. Despite record pension contributions by state and local governments, unfunded liabilities continue growing because interest accumulates faster than payment rates. In 2023, governments paid $180.7 billion into pension systems, nearly double 2007 contributions, yet the national shortfall remained above $1.2 trillion. Think about what that means. Taxpayers fund pension contributions that consume 31% of government payrolls. But the debt keeps growing because promised benefits exceed mathematical possibility. Current workers pay more while receiving less, subsidizing promises that cannot be kept. Meanwhile, something else is happening that proves institutional investors understand the timeline for systematic failure. Public pension funds increased alternative investments to 31.7% of portfolios, desperately chasing higher returns through private equity, hedge funds, and real estate speculation. These alternative investments charge 2 to 3% annual fees whether returns are positive or negative. Pension funds pay Wall Street billions in management fees while accepting reduced transparency and increased risk. When safe investments like treasury bonds can't generate required returns, pension funds gamble with retiree money. But alternative investments create additional problems beyond fees and risks. 25% of pension assets are now priced through valuation methods rather than market prices. Pension funds can't determine actual net worth because private equity and real estate holdings use fictional pricing. When pension funds can't calculate current asset values accurately, how can actuaries project future solvency? The answer is they can't, which is why pension projections consistently prove overly optimistic year after year. Here's what I discovered that shows how the crisis extends beyond public pensions to every aspect of retirement security. Private sector pension coverage collapsed from 50% of workers in 1985 to 15% today. Corporate America eliminated defined benefit pensions and shifted retirement risk to individual 401k accounts. The 401k transition created systematic wealth transfer from workers to Wall Street. Management fees consume 1 to 3% of account values annually over 30 to 40-year careers. A worker earning $50,000 annually loses $165,000 to fees over their career, money that could have funded retirement. But fees are just the beginning of 401k failure. Market timing risk forces workers to hope that markets perform well during the specific decades they re-saving for retirement. Workers who accumulated savings during the 2000s lost massive wealth in 2008 with no time to recover before retirement. Traditional pensions pooled longevity risk across all workers. 401k plans force individuals to guess how long they'll live and plan accordingly. Half of retirees will live longer than average, running out of money before they die. Meanwhile, something disturbing is happening that reveals how political leaders understand the crisis but refuse to acknowledge it publicly. Congressional Budget Office projections show that without changes, federal spending on Social Security and Medicare will consume 100% of federal revenues by 2045. That calculation assumes everything else the federal government does, defense, education, infrastructure, science, law enforcement, gets funded entirely through debt. Obviously impossible, which means massive benefit cuts or tax increases become mathematically inevitable. But politicians can't admit this reality because acknowledging the problem requires painful solutions that voters reject. Easier to promise impossible benefits and leave the crisis for future politicians to resolve. Here's what I found that proves the timeline is compressing faster than official projections suggest. The number of workers aged 75 and older is expected to nearly double over the next decade. These aren't people choosing to work for fulfillment. These are people who cannot afford to retire. Retirement has become financially impossible for most Americans. Only 44% can afford a $1,000 emergency expense. Yet they're expected to accumulate $1 to $2 million for 20 years of retirement. The mathematics don't work for ordinary workers earning ordinary wages. Social Security provides poverty-level income while requiring ever higher contributions from fewer workers. Medicare covers basic health care while requiring expensive supplemental insurance that many retirees cannot afford. The three-legged stool of retirement security collapsed into one broken leg. But there's an additional factor that makes the retirement crisis uniquely dangerous for social stability. Generational wealth transfer patterns that assumed property values and investment returns would grow indefinitely. Baby boomers accumulated wealth during the greatest economic expansion in human history, 1945 to 2007. They assume they can sell homes and investments to fund retirement, while younger generations buy those assets at inflated prices. But millennials and Gen Z face student debt, housing costs, and stagnant wages that prevent wealth accumulation. When 76 million baby boomers simultaneously try to sell assets to fund retirement, buyer demand won't support seller expectations. Asset price collapse becomes inevitable when demographic trends force massive selling with insufficient buying power. Real estate, stocks, and bonds all face downward pressure when retirement funding needs meet reduced buyer capacity. Meanwhile, something else is happening that accelerates the crisis timeline. Corporate pension dumping through bankruptcy proceedings has become routine business strategy. Companies promise pensions during profitable years, then transfer pension obligations to the Pension Benefit Guaranty Corporation during bankruptcy. The PBGC assumes pension responsibilities but caps benefits at much lower levels than workers were promised. Current PBGC liabilities exceed assets by $51 billion and growing. When the PBGC becomes insolvent, federal taxpayers inherit corporate pension obligations that companies abandon strategically. Private sector irresponsibility becomes public sector liability. Here's what the systematic collapse looks like when demographic pressures meet financial mathematics. Multiple state pension systems declare insolvency simultaneously, triggering federal intervention. Retiree benefits get slashed 20 to 40% through emergency legislation. Social Security trust fund depletion in 2033 forces automatic 21% benefit cuts for all recipients unless Congress raises taxes or eliminates the income cap on Social Security taxes. Medicare hospital insurance cuts payments 11% the same year. Mass protests by retirees whose benefits were slashed create political instability. Younger workers refuse to fund systems that won't exist when they retire. Tax revenues decline as workers participate in underground economy to avoid confiscatory taxation. Economic recession deepens as retiree spending power disappears. 67 million Americans over 65 reduce consumption when fixed incomes can't support inflation-adjusted living costs. Businesses dependent on retiree spending face revenue collapse. But the most devastating consequence affects intergenerational relationships when promises made to workers over 40-year careers prove mathematically impossible to keep. Social contracts break down when governments cannot honor fundamental commitments to citizens who plan their lives around official promises. Smart institutional money understands these trends and has been positioning accordingly. That's why Warren Buffett, as Berkshire Hathaway, holds $168 billion in cash rather than pursuing growth investments in an economy facing retirement crisis. Investment managers quietly reduce exposure to assets dependent on retiree purchasing power while publicly maintaining optimistic projections about long-term economic growth. They understand that demographic mathematics trump monetary policy when worker-to-retiree ratios collapse. Meanwhile, ordinary Americans remain completely unprepared for retirement security systems that promise benefits mathematics cannot deliver. They continue contributing to 401k accounts and paying Social Security taxes while assuming promised benefits will materialize despite obvious mathematical impossibility. The warning signs are everywhere. Record pension contributions failing to reduce unfunded liabilities. State insolvency timelines accelerating. Social Security trust fund depletion approaching. Private pension abandonment accelerating. But the most important signal is demographic inexorability. Birth rates and longevity trends that create worker-to-retire ratios are established decades in advance. The pension crisis wasn't sudden or unexpected. It was mathematically guaranteed by demographic trends visible since the 1970s. This isn't about economic policy or investment strategy. This is about fundamental mathematics when promise obligations exceed payment capacity indefinitely. When 76 million baby boomers retire while only 55 million workers replace them, the arithmetic becomes undeniable. I'm not telling you to panic about retirement planning. I'm not giving financial advice. What I am giving you is mathematical analysis that shows retirement security promises cannot be kept when demographic trends make them financially impossible. When New Jersey's pension funds deplete by 2027 when Social Security cuts benefits, 21% in 2033, when 83% of workers face retirement poverty despite $38 trillion in accumulated savings, the primary problem becomes obvious regardless of political promises or financial marketing. The choice isn't whether this crisis will occur. The choice is whether you understand the mathematical inevitability and plan accordingly before demographic reality forces recognition on everyone simultaneously. But there rests something even more disturbing I discovered about how the crisis is being hidden from public view. Pension accounting standards allow funds to use smoothing techniques that spread investment losses over multiple years, disguising the true extent of underfunding. This accounting manipulation means current pension-funded ratios are artificially inflated. The real shortfall is 20 to 30% worse than official reports suggest because losses from recent market volatility haven't been fully recognized yet. Meanwhile, something else is happening that proves the timeline for crisis is accelerating beyond control. Pension fund cash flows turn negative across most systems, meaning annual benefit payments exceed contributions plus investment income. When pension funds experience negative cash flow, they must sell investments to pay current retirees. Forced asset sales during market downturns lock in losses permanently, rather than allowing recovery during eventual market rebounds. Here's what I found that reveals how corporations systematically destroyed private pensions while enriching executives. Corporate pension funding declined from $1.8 trillion in 2007 to $1.30 trillion in 2024 despite massive stock market gains over the same period. IBM exemplifies this strategy perfectly. Between 2005 to 2024, IBM eliminated defined benefit pensions for new employees while spending $140 billion on share buybacks. Executive compensation increased 340% while worker retirement benefits disappeared entirely. But there is an additional factor that makes the pension crisis particularly dangerous for municipal governments. Public employee unions negotiated pension enhancements during temporary revenue booms without considering long-term funding sustainability. California's pension enhancement legislation passed in 1999 increased benefits 50% for many employees while assuming stock market returns would continue indefinitely at bubble-era levels. When markets returned to historical norms, the funding gap became catastrophic. Meanwhile, something disturbing is happening that shows how pension crises create cascading failures across interconnected systems. When pension funds become distressed sellers, they dump municipal bonds, corporate bonds, and real estate investments simultaneously. Here's what I discovered that proves the crisis extends globally beyond just American pension systems. Japan's aging population requires pension fund asset sales worth $200 billion annually to fund retiree benefits. European pension systems face similar demographic pressures with declining birth rates and increased longevity. But here's what makes the American pension crisis uniquely dangerous compared to international counterparts. Political gridlock prevents the policy changes needed to address mathematical realities before complete system collapse. European countries implemented pension reforms during the 1990s and 2000s, gradually raising retirement ages and reducing benefits to match demographic trends. American political system proves incapable of similar adjustments because any benefit reduction triggers electoral punishment. Meanwhile, something else is happening that reveals how quickly the crisis can accelerate when confidence collapses. Pension fund investment strategies assume they can liquidate assets gradually over decades to meet benefit obligations. But if retirees lose confidence in pension system solvency, they might demand lump sum payments immediately rather than waiting for gradual monthly benefits. Mass lump sum requests could force pension funds to liquidate entire portfolios within months rather than years. Here's what the complete systematic failure looks like when all these factors converge simultaneously. Multiple state pension systems announce insolvency during the same fiscal year, triggering federal intervention debates that reveal the scope of unfunded federal obligations. Congressional analysis shows that federal pension guarantees plus Social Security obligations exceed $50 trillion, while federal revenues total $4.5 trillion annually. Even eliminating all other federal spending cannot fund retirement promises made to current workers. Economic recession deepens as consumer spending collapses when 76 million baby boomers lose purchasing power simultaneously. Housing markets crash when forced retiree selling meets reduced buyer demand from younger generations, burdened with supporting insolvent pension systems. But the most devastating long-term consequence affects social trust when institutions systematically lie about mathematical impossibilities for decades while collecting contributions from workers who plan their lives around official promises. When governments cannot honor the fundamental social contract, that workers who contribute throughout their careers will receive promised benefits in retirement, democratic legitimacy itself faces crisis as citizens realize their leaders knowingly made impossible promises. Smart money understands this timeline and has been positioning accordingly. That's why private equity firms are buying distressed municipal assets at massive discounts. That's why sovereign wealth funds are reducing exposure to American pension obligations. The choice facing every working American is simple but brutal. Acknowledge that promised retirement benefits are mathematically impossible and plan accordingly, or continue contributing to systems that cannot pay promised benefits when demographic reality eliminates funding sources. What do you think happens when 100 million Americans discover that retirement promises made over their entire working careers were mathematically impossible to keep from the moment they were made? The demographics are fixed, the mathematics are clear, and the timeline is accelerating whether we acknowledge the problem or continue pretending it doesn't exist.